Yeah. Hi, a warm welcome to our private equity webinar from the BVH. Today it's going to be our first private equity webinar from our three sessions. That's the first one today. It can be part of the Chartered Financial Analyst, which is certified finance student. So you can also take the points from the test, which is going to be after the third webinar. You can also account them on your on this certificate. This seminar will be completely in English, so you can ask questions either in English or in German. We will answer them after every chapter. So let's go with our private equity webinar and let's have a look on our structure. That's the structure for the whole three seminars. Today there will be a focus on the first 3 points: definition of private equity, different forms of private equity investing, and conceptual foundation of buyouts. We'll make a deep dive today into the first 3 points, and in the upcoming webinars you will also have some knowledge about public corporations versus private equity companies, private equity firms as financial intermediaries, fund lifecycle and fundraising, fee components, performance measurement and distribution, and last but not least, observed performance of private equity funds, which is indeed a really important topic in our current situation. So let's begin with the definition of private equity. Maybe some of you already have heard of private equity. It is a term that is more used, that is used frequently in the last time. But what is private equity? Well, first of all, private equity in a broad sense is the equity financing for non-growth companies. And especially they are limited in time, so investments typically, they extend over a period about 7 to 12 years. Their focus are capital gains for the investors, and they are also value adding for the company. So that's the broad definition of private equity. But we also have to look for a narrow sense, since private equity can sometimes be misunderstood as venture capital. Venture capital we are venture capital when we are financing newly formed companies, so companies with not too much revenues. Of course, it depends on the investor what is too much and what is not, but private equity itself is a financing for more established companies. For rule of thumb, you can think about venture capital investments are into companies with, let's say, not more than 5 million revenue per year, and private equity financing is every investment in companies with revenues above 5 million. So we are talking about bigger and more established companies here who are seeking growth strategies which they cannot do organically. So let's move on. We understood what is private equity. We are talking about private investments into non-listed companies. But which kind of investors do we have? Well, we can differentiate the investor type by formality, actually, because there are some investors which tend to be more informal and others are more professional. If we are talking about informal investors, it becomes from left to right, the degree of professionalism increases. The most informal investors are most probably your family, friends, and fools. Just think about Facebook starting in a really small environment where the founders had to find some money, and the first persons they went to were just their friends, asking them for money. Like, no really formal investors, no structured deal approach. The little bit more professionalized investors are crowdfunders, which you can maybe find on Kickstarter.com or similar platforms where you can crowdfund with a really micro investment into a private company. We can see business angels, which are mostly ex-CEOs or really professional people who have a lot of knowledge in this field, who are trying to invest into your company and help you with money, but also with skill. We named this smart money because it's not just money, but it's also knowledge that is transferred. Incubators are somehow between informal and professional investors because they tend to be a really diverse segment. Those are platforms that are especially established for venture capital, for small ventures, for startups, to help them orientate themselves in the market and to find their right growth strategy. And the most professional investors are private equity firms and venture capitalists. Both investors would have about the same degree of professionality, since they do this also professionally and with a team with a lot of knowledge. Yeah. From this perspective, you can also see overview what different kind of investors are there in the market. But how does a private equity investment actually work? How does the company itself work? Well, you can see it here really nicely. There is a limited partnership. It's a legal structure for closed and PE funds. We can start with the limited partners. Everything starts with the money. Also in this case, so it starts with, let me use my mouse so you can see it. It starts with the money being invested into a limited partnership, into a private equity fund. This can be a newly formed fund where, for example, Bain Capital or Cinven is making a fund and they're saying, okay, in the next 3 years, we're going to invest in medtech companies. We are going to invest like 200 million and we are expecting an internal rate of return, let's say about 15%. These are our conditions, more or less, and you can invest. Allianz or München RE comes in, says, okay, just take my money and invest it. So what happens next? The limited partnership has the money to fund or to buy private companies. So they do an investment into a portfolio company, let's say Stada Arzneimittel. And after the years, this investments also bring some returns, like proceeds. And after collecting the proceeds, there's also an exit, a sell of the company, where you also get a big proportion of the initial investment. So after the exit and return phase, the limited partnership got returns from their investment, which they now have to share. How do they share it? First of all, the general partners, which are the fund managers, they get a management fee and a carry. They get a fixed fee for the management and performance measured fee, which is called the carry. But we will have a deep dive on this in a later webinar. But they're also invested with their own money into the private equity funds. That's also something really important. They are not invested with too much, like more about like 2%, but they are invested, and that's also important in order to have aligned interests. And the rest of the money, which does not go for management fees and carry, goes to the limited partners as preferred interest and return. So that's basically the structure of private equity partnership. The limited partner gives the money. The general partner invests it into a portfolio company. The portfolio company generates returns and the exit value. The exit value and returns are distributed among the limited partners, which get the biggest share, and a smaller proportion which goes to the general partners. So let's go on. So generally, PE funds can be differentiated according to some criteria. Most important is the investment focus. When a private equity company is thinking about setting a new fund, they have to think about the investment focus. Where are we gonna invest in? Are we gonna be in more like seed financing or more like buyout? It depends on how much are you going to pay for a company and what's the strategy you want to fulfill. From another perspective, also the portfolio management is important. So what are my value propositions for the company? Am I a financial engineer who is good with numbers and therefore does some financial engineering, making the books look better, and at the end of the day have like higher working capital and higher returns, which was quite popular in the early stages of private equity, but now it became less relevant? Or are you gonna be involved in the operations, improving them and having a hands-on mentality on the operating daily business of the company, which is more the strategy that the most companies have nowadays, since also portfolio companies are seeking for smart money and not just money with financial engineering. Which is also another big topic, is the location of the targets. For sure, there are interesting countries for investments all over the world. Some have a higher return, others have a higher volatility, but you have to make a decision about where you're going to invest. So European, you have German funds are most probably focused on DACH region or Europe in general, and US is maybe operating worldwide except for China and India. Maybe some kind of disallocation, but it is important to have allocation of geographies you want to invest in the first place. And having decided on the investment focus, it is also important to decide on the fund type. We can differentiate between two fund types. We have independent and dependent fund types. The most important funds or the biggest funds are generally independent funds. And those funds are backed by many different investors and are organizationally not linked to one of the investors. So they are completely independent. I mean, not really completely independent, since the investor always has some influence. But theoretically, they are independent in their investment decisions. And into these independent funds, we have listed private equity funds, which are differentiated into three subcategories, and we have non-listed private equity funds. This second one was supposed to be the non-listed private equity funds. So let's start with the listed private equity funds. We have direct listed private equity companies. So just as for an example, 3i Group, these private equity companies are directly listed. You can invest into them, and by investing into this stock, you are indirectly invested into all of their portfolio companies, and so therefore on all of their portfolio companies' growth. You have listed private equity fund managers, where you do not invest into the private equity companies the fund is invested in, but you are investing into the carry of the management. So this differentiation is sometimes not really easy to understand. You can think of it like this. The first one, you invest into a specific fund. Let's say Goldman Sachs has 10 different private equity funds, and you are investing into one of them. Let's say in the sixth one. In the second case, you are not investing into one of the 10 funds that Goldman Sachs has, but what you do is you invest into the Goldman Sachs private equity general manager directly. So you are involved into all returns that are generated from all 10 funds. So you are kind of more diversified since you have more investments, but you are also not focused on one fund, which can be a really important point when you are thinking about the asset allocation. And we have listed indirect private equity funds like Pantheon, where they hold stakes into companies that are actually listed. This can also be the case when you get private equity companies which also do public investing, but which is a kind of a special case which we are not going to have a deep dive on. And then we have non-listed private equity. Those funds raise their money from a number of personal known investors via the private capital market. Let's say there's a private equity company establishing themselves here in Munich, and they are thinking about, okay, now I need some money. Let's ask some pension funds, let's go to some banks, some insurance funds, and ask them whether they want to differentiate their asset allocation and also invest into my private equity fund. This could be one approach. Another approach are dependent funds, where one investor holds more than 50% of shares. This is mostly the case. We have, like, for example, captive funds, where the investor is a financial institution. Think of, for example, KfW. KfW is a financial institution itself and has a fund where he is investing, and he is also a majority stakeholder. So this fund effectively only invests in the interest of the KfW and of nobody else. Or we also have corporate funds where investors are industrial companies. Like most bigger players nowadays have a corporate fund, whether it is venture kind of style or private equity kind of style, where they try to find innovative companies and invest into them. All of them have it. Is Mercedes, Bosch, or SHP. All of them have a fund where they are trying to invest into fast-growing companies where maybe the technology is somehow similar to their own ones, or where they're trying to fulfill some strategic targets. But how big are these private equity funds actually? Because it is important to have kind of a feeling how big this market is nowadays. So we're talking about 25 billion fund size of the Apollo Investment Fund 9, which is publicly listed. It had a vintage year of 2017. Vintage year means the year when the fund had its first investment. So it's the starting year actually. And we can also see their investment focus, like we have Buyout fund, and we can also see the geographical focus is on North America and Western Europe, and the fund type, it is an independent fund and limited partnership. I don't want to focus on the different investment focus that we can see here, but you can maybe see one thing in the investment focus here is that all the bigger funds are buyout funds. So when we are talking about the biggest funds, we are typically talking about funds who are buying the company themselves for buyout and not just giving them growth equity. So that's for you to have a little feeling, which is how big the market is based on fund size. But let's also have a look on the investment cycle of a private equity company. When we are looking onto a private equity company, it has to deal with two types of clientes. It has its investors and it has its portfolio companies. The general manager of the private equity fund has to deal with the investors for getting his money, which he does during his fundraising. He goes to different big players, people with money, or institutions, corporates, and asks them to invest into their fund. That's the first part from the investor perspective. After they took the money, actually, they close their funds and they can start investing. After they start investing, apparently they don't need to fundraise anymore. What they do then is just to keep their investor relationship all right. They do this by reporting to them, by having them up to date on critical topics, so the investors always know what is going on and how the performance is. And at the end of the fund life cycle, there's a distribution of the returns where the limited partners get their investment back and also the returns and exit returns that have been generated. From a portfolio company perspective, it is a little bit different. We have investment origination, which is where everything begins. You are searching for companies that you want to buy, companies that fit your investment criteria and your investment focus. After finding such companies, which can be a really hard job, which since this market is really competitive, we are having an investment due diligence where you are having a look on the company, having a deep dive on its financials, on its operations, on its market, having a really big analysis about how and why this company should and can grow. If the company fulfills your due diligence standards, you can develop the investment and also invest in the company and structure it rightly. So you give the company not all the money from the beginning, but you can have milestones, for example, where you say, okay, that's the plan. We want to give you 20 million. We will give you this in 3 tranches. In the first one, you will get, let's say, 5 million, and you have to do A, B, C, and D. After fulfilling this, you will get the next 5 million, and afterwards, you will get the last 10 million after fulfilling specific milestones. So that's how investments are structured in general. And at the end of the day, you have an exit where you sell all your shares that you have in this private company to a financial or strategic buyer. And after realizing this, you can distribute your returns. Okay, so that was the first part, and let's have a look whether you got any questions or not. Are there any questions? Okay. Dann mache ich einfach mal weiter. Ich muss Slack muten, habe ich gelesen. Excuse me, these are some technical problems. I've heard that you're hearing me twice, so I have to mute this and just go on. Okay, let's go. Different forms of private equity investing. Which kind of different private equity firms do we have? Well, we have private equity funds, which we already have discussed, and those private equity funds, like you have the investors, they fund private equity funds, and these private equity funds do investments into portfolio companies, and those investments generate returns. But there are also 2 other kind of investment types. Well, first of all, what investors can do is also have a direct investment into portfolio companies. They can say, okay, I know this company, its performance is going to be good. I don't need any intermediary like a private equity firm for this. And I can invest directly into this company, which can also be a kind of a private equity investment. But what investors also can do is they can invest into fund of funds. A fund of fund is a fund which invests not only in one, but in multiple private equity funds. And those private equity funds are invested into portfolio companies. So let's say you're a fund of fund, you are typically, let's say, investing about 50 private equity funds. And those 50 private equity funds are investing each in, let's say, 10 companies. So you are indirectly invested into 500 portfolio companies via 10 private equity funds, which can be also a really good strategy since you can allocate more money in fund of funds since these are bigger, and you also have less volatility, which we'll see in the next slide. If we look on the risk-return profile on different forms of private equity investing, we can see a distribution that is really sound. Like we can see that direct investments have, first of all, the highest probability to fail. The other one apparently don't have one. at least on average. But the direct investments they have high risk, but they also have a high return profile. We can see that the volatility is really high here. We can also see that about 1/3 of all direct investments are failing, but we can also see that about 15% of all direct investments realizing a multiple of over 10. So that means that the initial investment brings a return of more than 10 times itself. If we are looking on the fund investments, those are investments done by private equity funds. We can see that the distribution is a little bit flatter. It's a little bit more concentrated. The risk and return profile is intermediate. We can see we don't have too many companies failing, but we can also see that above a multiple of 4 is not really likely to happen, and then also returns of more than 10 times is not really likely in this case, but we can see that the risk is also reduced. In the fund of funds case, where you are invested in the most of the companies, so here you are invested in one company in the direct investment. In the fund investment, you are typically invested into 15 portfolio companies, and in a fund of funds investment, you are typically indirectly invested into about 200 to 500 portfolio companies. So you can see here that realizing returns less than 1, so losing money is almost not possible according to the statistic, but also the return profile, the upside is not too high. So you cannot really expect to realize returns more than 4, but therefore you also have less volatility. So it's the classical phenomenon, more risk comes with more possible return, and less possible return has lower volatility. Let's have another look on different fund types. So we discussed which different fund types we have depending on how their investment, funds of funds, or direct investment or private equity investment, but we can also differentiate them on the limit to the volume and lifetime actually. We have close-end funds. These funds are the most popular ones. Most funds, I would say more than 90 or maybe more than 95% of all funds are closed-end funds. They have an upper limit for the fundraising with a specified subscription period. So you can say we have 1 year to collect 150 million, and you will start after this 1 year, regardless of how much money you have collected. Okay, if you didn't collect anything, you can start, but if your target is 150 million and you only collected 100 million, you will still start after 1 year and not postpone it. In close-end funds, this is a little bit different. Investors can continually make subscription to the fund. So first of all, there's no upper limit since it is not defined. And second of all, you can invest in any point of time. Not immediately, but you can invest whenever you feel comfortable with it, which can be a real advantage. I'm seeing here that we have 2 times closed-end funds. This is supposed to be open-end funds, actually. So these are closed-end funds, these are open-end funds. And the lifetime, we see closed-end funds have a predefined lifetime of about 10 years. After 10 years, the fund is over and all investments are tried to be liquidated, or I mean not liquidated, but all investments are tried to be exited. And in the closed-end funds, there are no predefined liquidation dates. Those funds are always reinvesting the returns and generating even more returns for its investors. And when we have a look on the distribution of returns, in closed-end funds, returns from investments are distributed to the investors at the latest possible date and at latest time at the end of the fund. And in open-end funds, the returns from investments are usually reinvested. So closed-end funds are typically a longer-term investment, but private equity itself is generally long-term investment. So we are talking about investment periods exceeding 7 years, which is quite long. But open-end funds are have even longer investment periods. Let's have a look on limited partnerships as a standard legal structure. Having a limited partnership, which is typically organized as a fixed-term partnership, 10 to 12 years, can also be a little bit less, but not really more than 12 years. You can find funds which have a fixed term of 7 years, but you won't find private equity companies with more than 15 years, I would say, or at least not too many of them. And this limited partnership is divided into its limited partners, which are the investors, and its general partners, which are the fund managers. The managers, they are deciding about which investment is going to happen, where are we going to invest, and how it's going to happen. And the limited partners, they are deciding at the beginning of their asset allocation whether they want to invest into your company, into your private equity fund or not. What are the differences? Well, the limited partner, he has no participation in the management, like I said. He's only invested with his money. He's not managing any of the companies, nor he's influencing them in any way. And limited partners are, just as the name says, they are only liable to the extent of the amount of money they have invested. General partners, they are personally liable for the debts of the partnerships, so there are stronger incentives that they perform since they are personally liable for it, and they are also responsible for the administration of the fund and of its investments. So we have on one side the limited partners which provide cash, and the other side the general partners which provide the service of the investment, which is typical asset manager style partnership. And the main advantage of this partnership is a tax transparent structure and flexibility in establishing the responsibilities of the partners. So you got a really flexible legal structure, and it's also from a tax perspective easier to have it in an own limited partnership than having it in your own in your own tax payments. Okay, let's go to the next slide. Institutional investors sometimes co-invest. What is co-investment? So let's think. I was saying that there are solo investments. Solo investment happens when a company decides to invest without the private equity company into a company. That's a solo investment. And a co-investment is an investment where only you and the private equity company invest in. So let's have a look on this. We have the solo investment where the institutional investor invests completely independent from anybody. Then we have the limited partnership, which we already discussed heavily, like we are investing in a private equity fund, and this private equity fund is investing into a predefined number of companies. And now there's a co-investment. A co-investment happens where you do not invest into the private equity fund, but you invest directly together with the fund. So the difference is that you are not going this way to the private equity fund. You are not paying the conditions that you have to pay here, but you're directly investing together with the private equity fund, where you are avoiding fees effectively and enhancing your return profile. So how does this happen? And why does this happen? Why should a private equity company invest together with you into companies with voice conditions for them? Well, those are the reasons, therefore, are mainly complementary capabilities. Sometimes the limited partners, they have the money, but the general partner, he's trying to invest into a company that is out of his range. Let's say the private equity company typically invests into companies with a ticket size of 10 million, and there is a company which they could invest in, which seems to be really lucrative, like really high growth rates, and market is also really stable, but they would need an investment of about 60 million, and he can't do this with his current private equity fund. So he's seeking a limited partner which says that he's going to fund this money, and they are investing together in a co-investment. So this is especially relevant in times where deal flow for larger investments, so investments which are out of your range, are good, but the fundraising is difficult. Then this becomes really interesting, which can be the case in the upcoming months and years. When we're talking about the corona crisis, we can expect that many private equity companies are going to struggle with their fundraising, since limited partners are going to look closer to the funds where they are investing in. And this will bring many private equity companies to more often use this co-investment vehicle. So, what are the advantages of co-investments from the limited partner perspective? You can build a targeted allocation to specific investments. So you can say, okay, I got my asset allocation, but actually I need a few high risk assets also in my portfolio. So maybe I could invest together with a private equity fund on some opportunistic deals. It can enhance your return profile, since you are not paying the fees that you would need to pay in a private equity, in a limited partnership. You are enhancing your return profile. So actually, you are improving your net returns. Your gross returns are typically the same, but the net returns, so the returns after after accounting for the expenses that have been made, they just increase. You have a dual level review for investments, while the difficult due diligence work is transferred to industry experts. You are reviewing the investment by yourself. In this case, in normal private equity partnerships, you do not. Also, private equity company itself does it, so you got like a double check, cross check, which can be sometimes also be really valuable. The fourth point would be the improved monitoring of the fund and reduced information asymmetry between fund managers and the investors. Since you are closer invested in the company, you also get more information about the company, and so you have less information asymmetry. You know what's going on right immediately. You do not have to wait like every 2 or 3 months for the private equity magazine, where it's not magazine but report that is given to you, where you can read through the current status of your investments. And what can be really, really interesting is that limited partners can participate in top tier funds through co-investments, because top tier funds, for example, like KKR or the Apollo 9 fund that we just seen, and these are funds which are really popular and where the demand is really high. They are oversubscribed, and everybody wants to get into these funds, but only a few are chosen, but everybody wants to get inside since they are offering the best returns. So in this way, you didn't get inside the Apollo 9 fund, but you're talking with the Apollo 9 fund manager and asking him whether there are co-investment possibilities, and you just use these co-investment opportunities to get access to top tier funds, which can be also really interesting from asset allocation perspective. Okay, now we are in third and last chapter. So let's again check for questions. Are there any questions? Okay, I have to unmute Slack now, I guess. I'm sorry for the technical issues, but home office is not always so easy. Okay. Are there any questions? Okay, it seems like there are no questions. Is that right? Okay. Let's go on then. With the conceptual foundations of buyouts. Well, what is a leveraged buyout? A leveraged buyout, per definition, is the acquisition of a company, division, business, or collection of assets using debt to finance a large portion of the purchase price. The remaining portion of the purchase price is funded with an equity contribution by a financial sponsor. So the most important part of a LBO is that the biggest proportion is paid, the biggest proportion of the acquisition is paid with debt. So we are talking generally about 60 to 70% debt and 40 to 30% equity, which can be more or less depending on the acquisition case. And the money for the equity contribution actually comes from a financial sponsor, which is just a synonym for the limited investor, which is in this case the financial sponsor. We can see some large buyout deals in 2017. We can see Toshiba Memory Corporation. It's like, okay, I think in US dollar it should be about 18 billion. And we can also see some other big deals, mostly buyouts. We can see a few big public to private deals, which are also really interesting. Well, we keep in mind that the biggest private equity funds are buyout funds, and the reason for this is just that buyouts are the most capital intensive private equity strategy, since you are acquiring the company itself. Let's move on. So we have an LBO. We can distinguish an LBO from a buyer and a seller point of view. So let's start with the buyer point of view. Depending on who's buying, the kind of investment you are doing changes. Which is the most popular thing is actually an institutional buyout, where the private equity investor initiates the transaction, acquires the business directly from the vendor, and often the target's management will also take a small share into the company. So an institutional investor coming inside the company, buying it, and then he runs it himself. And he's giving also the management some performance-related incentives to align interests. If the current management is buying the company, which can be also the case, which is called the management buyout, shortly MBO, is an LBO originated by a target's existing management with the support of a private equity firm. Let's think of a company that is where the management does its job quite well, and he sees, okay, I got some plans, but my shareholders, they are not accepting them. But I think if I use the strategies that I have on my company, then it will grow 5 or 6 times faster than it's doing now. It goes to private equity companies, pitches the idea, and asks them to invest into his company in order to change the shareholder structure and in order for him to get get the okay for the projects that he's searching for. Another kind of investment which also happens quite often is a management buy-in, where you come into the company, you're buying the company as a private equity firm, and the first thing you do is changing the management. This can have different reasons. The management maybe had a low performance in the past, therefore you're changing them. Or maybe the management did a really good job up to this point, but for the next steps, which could be a really big steps, you need a more senior executive board, people with more experience, people who bring more value into the company. This can all be good business cases for management buy-in. And you got an employees buyout, which actually almost never happens, an LBO in which employees buy a majority stake in their own firm. By myself, I almost never heard of something like this, but from a scholarly point of view, we also should mention it since it can be the case. And having another look, not on the buyer, but on the seller, there are also different reasons why a person is selling. Most important selling reasons in Germany are succession problems, actually. We have a really old demographic, and therefore we can also expect that the managers who founded their companies 40 or 50 years ago, they are now retiring, and they have a succession problem since maybe they don't have anybody to pass the company to, and so they're selling their life work to just a private equity company to exit it. That's something that happens quite often, especially in Germany, and it's also something that's gonna happen in the future more often since, as mentioned, the demographics of Germany is improving. And spin-off, I'm sure you already heard of spin-offs. These are cases where a company maybe has several divisions, and there is one division which doesn't really fit to the other four divisions, and for market reasons or for product reasons, just think of a supermarket who is selling 100 different products, and he's also offering a car wash, but apparently the car washing can be lucrative, it can be profitable, but it doesn't really match to his other kind of assets. So he's saying, okay, I'm gonna sell the car washing so that I can focus on my supermarket and on my 100 products, which is more the business that I like and which is more the business where I got experience in. We got turnaround. Turnaround can also be a reason. This is also something that's gonna increase in the future since we have the COVID-19 situation, which is gonna bring many companies to financial distress situations where turnaround cases are created. These are cases where the company is maybe not profitable anymore, or the company is 1 or 2 months away from insolvency, and you need to somehow stop the bankruptcy. These are also interesting cases that happen a lot. You have privatization, where governmental organization is taken private. You have also a going private. You have to differentiate these two. Privatization is a governmental organization that is taken private, and going private is a publicly listed company in a stock exchange which is taken private, also called delisting. And you have growth cases. Growth cases are especially important for venture capitals or smaller private equity investments which just need money for expansion. For example, you want to expand, you are currently in Europe and you also want to expand into the US, so you need the money to establish your sales offices and etc. And therefore you just need the growth financing. Okay, this is a really important slide. Limited partnerships are standard legal structure, the closed-end funds. What are important factors for a leverage buyout? Which factors do you need in order to say, okay, this is a good leverage buyout case? The most important thing for a good LBO case might be a strong cash flow generation. The predictability of cash flows is something that is really important in a leverage buyout. If you can predict the future cash flows, you can more securely say also communicate with the banks your upcoming cash flows, and therefore the banks are more willing to pay the high amount of debt. Since you should not forget, in an LBO case, the most of the money comes from the banks, and therefore you have to convince banks why your investment is going to be profitable, and this can be done really good if the cash flows are predictable and not too volatile. Competitive market position is also something that is of course important. You need a unique market position in order to be competitive and also to generate the returns that you are proclaiming. If you don't have a competitive market position, then you cannot expect your investors to believe that you will grow by 50% every year, which is quite a lot, but also 20% a year is a really high growth potential. You need growth opportunities in itself, so you can have strong cash flow and also competitive market position, but if you don't have many growth opportunities, maybe you are not the best fit for a leverage buyout. But this can also depend on the investment type that you're following. If you have predictable cash flows and a competitive market position, then you can also do a leverage buyout. You won't have increasing returns you won't have increasing revenues nor increasing EBITDA, but what you can do is just through financial engineering and through leverage, you can increase your return on the assets, which can also be interesting. A strong asset base is also important, since you are taking a big proportion of debt. A strong asset base can be used as a collateral for the bank, which can just improve your credit conditions. Low capex requirements, so it can be good if your capital expenditure requirements are not too high. They shouldn't be too high, since you want to pay the interest from the debt that you have that you lend from the banks. So you need the free cash flows that arise through your operations in order to pay the interest, and therefore you should have low capex in order to meet your interest payments. And the last point can be efficiency raising chances. Companies where not much automation has taken place or interconnectivity is a foreign word. For those companies, these companies are also really attractive sometimes, because sometimes you have companies which are already profitable and they're doing a good margin, they're having a good margin, nice expansion possibilities, but on top they give you efficiency raising chances, for example through automation, and those companies are really a good target in order to have a leverage buyout with. Regardless of all these 6 really important factors, the most important factor is a proven management team. Because you can have the best company, you can have the best car. If the driver is not good, then you can't use the car effectively. And it's also the same case in companies. If you have a nice asset which has a lot of potential, has low capex, etc., but the management team is not good, then you shouldn't invest in it. You shouldn't go for it. So therefore, a proven management team is a really important factor of private equity investments. So this was it from my part. I give you a final chance to ask questions. I can give you answers. I hope some arose. If not, then this is the end. I will wait for my colleagues. Are there any questions? Okay. It seems that there are no questions. Then this is it from my point of view. Thanks for your attention. If you have any questions in advance, you can also ask them afterwards. Myself, I didn't introduce me. I'm Hassan Basiano. You can contact me, ask the questions. You have my email, and you can also check out our website. And also Simon Guest, which also helped me with the presentation, who couldn't attend today. You can also ask him all your questions, so please feel free to reach out to us. Yeah. Gerne.